All right, let's go ahead and get started. This class is being recorded for purposes of Zoom. So a few things. This is the attendance sheet for today. Make sure you sign the attendance sheet for today before you leave. I'm going to start this on this side of the room. I also put an announcement today that has what I'm calling the attendance tracker, which is a Google Doc that you can access read-only, but I'm going to put your absentees in there. So all the unexcused absences will be in the attendance tracker. Okay. So if you want to kind of know whether you were here or not, that's a good place to remind yourself. Although if you weren't here, you should probably know that. But that being said, that's where the attendance tracker will be. All right. So today, before we get into finishing up lecture note 1, on Monday, we noticed that some people were having challenges with the HCA screenshots. Okay, and I got on with Bloomberg Tech Support, and one of the challenges that we found out is here, that if you go to HCA and you do an RV, for your assignment, what you have to do is make sure that you're using BICS, and you click on the drop down and you got to use healthcare facilities. Okay, but some people were saying they don't see that drop down, and I asked Bloomberg why. What they told me is that in your global settings, if you have that middle ribbon bar, then this drop down doesn't exist. So the only way to see the drop down is to get rid of the bar, right? So some of you, when I told you to get rid of the bar, you did. Some of you didn't. That's why you can't see the drop down. So what you're going to have to do, if you didn't get rid of the middle bar, settings, global settings, uncheck, show top section, hit close, and then you will see the drop down. Choose healthcare facilities, right? Many of you, which are not seeing 16 companies, told you global settings, comparables, this number of comps defaults to 10. Bloomberg stops at company number 11. Switch it to 50, 50, hit close, then redo the screen. That should get you 16. If you do all that, you still get 11, fine, turn it in. I'll tell the TAs not to ding you, but you must use BICS best fit algo, or you get a 0. If you use whole firm, you get a 0. So you must use BICS, and you must use healthcare facilities, and you must have market cap weighted average. Okay. Yes. Is what? Third. Does the third column matter? Does what it? No, this doesn't matter. Oh, location and domicile. You need to use U.S. healthcare facilities. We're not doing global, we're doing U.S., which is part of the assignment. Right? Oh, so region. Sorry, you said region. I said vision. All right. Any other questions? All right. So what I want to pick up with today is where we left off on Monday with the lecture note 1. So going back to that file. We talked about the concept of free cash flow, right? And we then left off on this slide. And the whole idea is, I said, that RoIC is a proxy for free cash flow. All right, so I want to show you how that works. All right, this slide will give you some of that math. So on Monday, we had this kind of made up company A, 100 million in OPAT, 50% reinvestment, 5% G, 10% RoIC. That on this slide is company A, right? And what I'm adding to this slide is company B, made up company, and A and B are in the same industry, so we're going to assume they have the same WACs, 10%. A and B also have the same profits, 100 million, and A and B have the same long-term growth rates of 5%. So 100 becomes 105, 110, dot, dot, dot. All right. So you have two companies with, on this slide, identical profits, identical growth long-term, and identical WACs. Based on the data on this slide at the bottom, would these two companies have the same value? Or would one company be worth more than the other? What do you think? Would there be a difference in value? Yes or no, and why? Are the free cash flows the same? Does one company have higher free cash flow than the other? If the company has a higher free cash flow, shouldn't it have a higher value? So your answer should be B. B should be more valuable. If you don't understand that, you should ask. Because I'll give you a preview. When you take the midterm exam, these are going to be the type of questions that are on the midterm exam. So I'm saying things in class and you're not following, you're not asking, and you fail the midterm exam, you have no one to blame but yourself, right? No question is a dumb question. Now's the time to ask the questions, right? So don't be lost. B is the more valuable company. Has more free cash flow than A for the same profits. And what I want you to understand is why. The reason B has more free cash flow than A for the same profits is B has less reinvestment. They're investing less than A. The reason that B has less reinvestment than A is because they have a better ROIC. Their ROIC is 20%. Their ROIC is 10%. So assume they're not cutting corners, they're actually better at what they do. Then B, because they have a higher ROIC, doesn't have to invest as much as A to make the same profits. Yes, sir. 20% ROIC. Investing 25 million. So lower investment, 25 million at 20%, gets you that 100 million of profit. Higher reinvestment, 50 million at 10%, gives you the same profit. Okay. Or let's say B reinvested 50, not 25. Well, if they reinvested 50 at 20%, their profit next year would be 110. All right. So the point is, because 20% of 50 would be 10, 100 plus 10 is 110. So the point is 110 profit minus the 50 reinvestment would still be a higher free cash flow today. So the point is, whether you have same investment, higher returns, you'll generate more free cash flow, or same profit, higher returns, you'll have less investment. Either way, you're going to have more free cash flow. So what I'm showing you mathematically is that ROIC equals free cash flow, right? If you have a higher ROIC, you will generate more free cash flow. You will become more valuable. Caveat, at the same level of growth. Okay, so as long as growth doesn't change, higher ROIC equals higher free cash flow. Right? Now, what gets complicated in the real world is growth doesn't stay the same. Growth rates change. They're not always the same amongst companies. And so that what makes valuation a little bit trickier, but that's the key to valuation. Okay, so to show you an example of this, here is bigger, so it's easier to see. Two companies. One company has a 10% ROIC. The other company has a 15% ROIC. So what does that mean? That means this company makes 10 cents per year, and this row 3 company makes 15 cents a year. Well, that continues. If I make 10 cents a year, somebody else makes 15 cents a year, the company making 15 cents a year will be more valuable. Okay, that's what I just showed you happened on the previous slide in a summary. Okay, but what if the growth rate changes? What if the company making 10 cents a year grows the 10 cents at a 10% rate? And what if the company making 15 cents a year grows the 15 cents at a 2% rate? Equals 15 times 1.02. So that over time, if that continues, by about year 6, the company making 10 cents at 10% growth will actually generate more cash than the company making 15% growing at 2% a year. And then if we continue on, over time, the difference becomes even more substantial, right? And so that's the whole point. Key value drivers. The value drivers are a function of both the growth as well as the return. And so that's the idea. So at the same level of growth, higher ROIC equals more cash flow, more value. But when the growth rates change, then it's a little more complicated, right? But that's valuation right here. This is valuation. Growth, spread, growth, return. Make sense? Questions? All right, back to our slides. So the difference between a company and a project is we assume projects ends and companies last forever. Now, none of us are going to be around to find out if that truly happens, but if nothing else, we assume companies last for a very long period of time. So if I'm going to value a cash flow forever, that's called a perpetuity. Cash flow divided by R. Now, if that cash flow grows at a constant rate forever, that's called a growing perpetuity. Cash flow divided by R minus G. That's just math, right? But that formula at the bottom of the page, cash flow divided by WACC minus G, the R minus G, that is the growing perpetuity. And that's actually what we use to value companies long-term, right? And that is called terminal value or continuing value, right? So the long-term value of the company is growing perpetuity. So take the cash flow, free cash flow, divided by R minus G, there's your valuation. That's what you're taught in previous classes. That's in the textbook, Brealey and Myers, Ross Westerfield, whatever your academic textbook is. That's what people use in the real world. That's the formula, right? But that formula has a very important mathematical limitation that people often don't tell you about or even know. That formula, cash flow divided by R minus G, assumes that the incremental ROIC equals the historical or current ROIC. Translation, whatever ROIC you make today, you make forever. Let's take a company like NVIDIA, which has 100% or so ROIC. It's going to make 100% ROIC into perpetuity. It will never do worse. It will never mature. It will never lose its competitive advantage. It will always make 100%. Well, you're likely to overvalue the company if it never goes down. Take a company like Ford, which has a 3% ROIC today. They're going to make 3% forever. They're never going to improve. And you'll probably undervalue Ford because you'll never give them any credit for any future improvements with this equation. So the problem with the formula that everybody uses, cash flow divided by R minus G, growing perpetuity, is it kind of exaggerates the current performance of the company. And it tends to overvalue and undervalue companies because of that, right? It's a limitation. It's what we do. And McKinsey said, okay, let's make this a little less bad, right? Let's try and improve upon this. What they did is they said, okay, let's rearrange some math. And so there were two parts of the equation we built on Monday. We said cash flow is free cash flow, which is profit times 1 minus the reinvestment rate. That's free cash flow, profit after reinvestment. And then they made a second substitution, said, okay, investment rate is based on the formula growth, G, is the investment rate times the ROIC. Therefore, investment rate can be replaced with growth over ROIC. So using those two substitutions, the formula left becomes the formula right. They're both growing perpetuities. The only difference is the version of the growing perpetuity formula right, called the key value driver equation, has ROIC in it. The growing perpetuity formula right, the left does not. That ROIC is incremental ROIC, which means using the McKinsey version, you could have a different ROIC for the future than the past. With the traditional version, you can't. That's the improvement. Now, that's one ROIC for the entire future of the firm, right? But nonetheless, it can be represented. So take Ford. Ford's making 3% today. I think they're going to make 8% long-term. Plug 8% in the formula, and I'll get a better valuation. NVIDIA's making 100% today. When they mature, I think they're going to make 20 to 25. Put 20 to 25 in that formula, I get a better valuation. Key value drivers. It's just a rearranged growth perpetuity, but fundamental because this is what we're going to use this semester. Make sense? Questions? All right, so what I want to do is I want to take that formula and I want to value these two companies. Because earlier I asked you if A or B was valuable, and we decided that B was more valuable because it generated more free cash flow. Let's be more specific. So plugging in this formula. We go back to Excel. And I'm going to use friendlier terms. The four parts of the formula are the expected profit, expected NOPAT, the expected growth rate, the expected G, the expected return on invested capital, the expected return, and the WACC, which I'll call the risk. If I put those four things in, I will get the value of a company. So there were two companies on that list, A and B. And here was their data. Both companies started with 100 million of profit. Both companies had a 5% growth rate. Company A had a 10% ROIC. Company B had a 20% ROIC. And they both had 10% cost of capital. So based on this information, we said B should be more valuable. Here's what the math would say. Using the key value drivers equation equals profit times 1 minus the growth divided by the ROIC divided by the WACC minus the G. This would say company A is worth $1 billion and company B would be worth $1.5 billion. So I'm just quantifying that B would be worth 50% more than A. Now, a step further, in the real world, there's something called a price to earnings multiple, PE. What is the PE of business A? Well, their price is $1 billion. Their earnings are 100 million. They would trade at a PE of 10. Company B, their price is $1.5 billion. Their earnings are 100 million. They would trade at a PE of 15. So A is worth 50% more than B on a cash flow basis. A would trade at a 50% higher PE. ROIC is the shortcut for free cash flow. Multiples are the shortcut for free cash flow valuation. Yes, sir.
You should have for that. Yeah, please.
This equation, which is on video here, is just the key value driver equation with the right order of operations. For purposes today, I'm not asking you to type it, but in a couple of weeks I will. because I'm actually about to give you a spreadsheet that has the equation in it. Other questions about the concept? Make sense? All right. I'm about to cheat a little, but we're going to use this throughout the entire class. All right, we're going to use this for valuation. We're going to use this for multiples, and you're going to use this beyond this class in the real world. It's very real world. And that's what I want to show you. Let's take the pharmaceutical company, Eli Lilly. They're on track to becoming the first $1 trillion pharmaceutical firm in terms of market cap. Okay. What's making Eli Lilly so valuable right now is a drug called Mounjaro. All right. Mounjaro is the Lilly version of Ozempic. Okay. Ozempic and Mounjaro are actually similar. They're both GLP-1s. But the only other difference is Lilly includes an additional chemical plus GLP-1, which Ozempic does not. So Lilly's drug, FDA approved, actually has demonstrated more weight loss than Ozempic. So you take Ozempic, you lose about 20% of your body weight. You take Mounjaro, you lose about 30% of your body weight. All right. But both are substantial in weight loss and are starting to revolutionize healthcare, because people that are taking both of them that have type 2 diabetes, gone, cured, never have to take medicine again, other than these weight loss drugs. All right. Because when you lose a lot of weight, a lot of good things happen to you. And it's not just diabetes, it's affecting a lot of other things. All right. Heart disease, etc. And so basically, these drugs have become very popular, right? Because of not just the weight loss, but the other health effects, but they're very expensive. They're an injectable pen. You take both of them once a week. The price of each pen is $1,200 a month. Okay. That's the cost of the drugs. Now, here's the other thing. If you stop taking either one of these drugs, all the weight comes back. So if you start this and you lose a bunch of weight, you're on this the rest of your life, which means you're paying $1,200 a month to these two companies for the rest of your life. All right. Now, the insurance companies don't like this because that's getting friggin' expensive. Right. And they never planned for this big drug for this many people. All right. But here's what it means to Lilly. If you look at Eli Lilly, EEO, earnings estimates. By 2027, Mounjaro, which was about $5 billion of sales last year, is expected to grow to $28 billion in sales. Zepbound, which is the high dose version of Mounjaro, same drug, just higher dose, different brand name. No sales last year, $19 billion a year in sales. So this one's for type 2 diabetes. This one's for weight loss. It's basically the same drug, got FDA approved, different brand names. So here's the point. This is almost $40 billion a year of revenue. The $1,200 pen is about $1,100 of gross margin. It's extraordinarily profitable. Okay. So they're making a lot of money. That's why Lilly is becoming so valuable. So here's the point. Let's use the key value driver formula to figure out their share price. Their share price today is $916.69. Okay. So I'm going to go to our key value driver equation. Okay. And here I'm going to cheat a little bit, because when you do a share price and you do an actual PE multiple, price to earnings, earnings is based on earnings per share, which is net income. It's not NOPAT. Okay. It's based on income. So expected profit is net income. All right. So next year, Lilly's net income in 2025 is expected to be $20,348,000,000. 20,348. Now, return on invested capital, because I'm dealing with net income, becomes return on equity. Okay, because it's the return to the shareholders. Net income is just shareholder money. Okay. Again, we'll talk more about why we're doing this later, but same process, right? So what is their long-term return on equity? Well, for the next 4 years, 86%, 74%, 62%, 50%. Let's just say somewhere around 50% is their long-term return on equity on this very high profitable drugs that they're selling. I'll say 50. Today, their discount rate, their WACC is 7.5%. But since I'm actually discounting net income, which is equity, I use the cost of equity. All right, 'cause equity cash flow, equity discount rate. So their WACC for equity purposes, cost of equity is 7.7. Now, what our key value driver equation would say is that at no growth, Lilly should be worth $264 billion. And their PE should be about 13. Right? In the real world today, that share price divided by earnings per share expectation, their PE closed today, or is about to close today, at 41.28. That's their real world PE next year, 41.28. So the question is, what growth does the market expect of Lilly? I'm going to goal seek this. So I'm going to basically say, set our formula to create a PE of 41.28 by solving for G. And Excel is going to tell me that their G for this share price would need to be 5.5%. This is Lilly's share price today. $20.3 billion of profit, growing at 5.5% at a 50% return and a 7.7% WACC is a PE of 41 and an $840 billion market cap. If I were to go to Lilly today and I multiply their share price of $9.15 times their shares outstanding of 950 million, I get a market cap of 869 billion. And I'm at 840. The difference is the cash. Add the cash. But that's the point. It should work. It has to work because that's the cash flow value. That's Lilly share price. Key value drivers. This is the 4 section of the class, by the way. So if you're like, I didn't follow everything here, that's okay. We're going to build to this, but I just want to show you a preview. All right. It explains stock prices. And when these things change, 5.5% becomes 6%. Then they go over $1 trillion worth of value and their PE goes to 52. So as we change the key value drivers, we're going to see what the impact on value is going to be and share price. That's the exercise. So what I'm going to do now is ask you to do an exercise. Okay, it's not for a grade. It's in class. And just work on ad hoc teams of like 3. Right? It's not your semester team, just in-class teams. And I'm going to give you 20 minutes to do a key value driver exercise that I developed for Duke. So you'll see some Duke branding, ignore it. Duke fellow, in addition to my lecture here. So on Elms, if you go to Files, now the folder under Files is called September 9th in class, because I thought we were going to get to it on Monday, but today's September 11th. Always take a little bit of silence. There's 2 files in this folder. There's a PDF and there's an Excel file. You need to download them both. All right. I'm going to give you 20 minutes in your little ad hoc teams. And what I want you to do is with the Excel file open, make the changes and answer the questions that are in that PDF. When you do that, it's going to give you 5 scenarios of what happens when key value drivers change. And those 5 scenarios are critical to everything we're going to do at a high level. If you understand those 5 scenarios, anytime you see a headline, piece of information, you're going to know what's going to happen to a company's share price, right? Because it's going to be one of these 5 scenarios. And this is going to help you just kind of keep, as we go deeper into the math, kind of a high level, okay, this is why it's doing what it's doing. I start to understand it. So that's what I want you to understand. These are critical scenarios of the key value drivers. So take 20 minutes, pair up, partner up, groups of 3, go through these, answer the questions in the PDF, and then we're going to discuss. All right, go. All right, so as I said before, there were some scenarios for key value drivers. So the first thing you were asked to do is to change the profit, 200, 300. What happened when you changed the profit? Yes. Oh, sorry, thought you were raising your hand.
We already tried the value.
But the multiple did not.
It's-
Yeah, value up, multiple down. So the point is, this is called sizing. All right, you're bigger. You are more valuable because you just generate more absolute amount of cash. All right, but you're not better. All right, it's just higher NPV. All right, don't have any difference in IRR. So that's the point. It's not going to change the multiple, but it is going to change the value. That's one way to become more valuable. Just go make more money. Right. But I want to talk about better. Better is a little bit of a different business model. Long term, different growth rates, different returns. That's better. That changes multiples. So that leads to the next scenario. The next scenario said, okay, reset. What happens when the growth rate of A and B increase? So instead of 5% a year, they start growing faster. So what happened when you change the growth of A higher? And what happened when you change the growth of B long-term higher? Anything change with company A when the growth rate went up? Why not? Yeah. But why isn't there value with A? Yeah, the ROIC is equaling the WACC. So basically, growth with no spread doesn't change any value. It's like saying I have a bunch of 0 NPV projects. I'm going to do more 0 NPV projects because my ROIC is 10, my WACC is 10. Pay off the WACC. There's no value being created, right? I like to call this the treadmill. Okay, you kind of get on a treadmill, you run really fast, you don't go anywhere, you just get tired, right? But that's the point. A lot of companies do this, like, oh, I'm growing, I should create more value. No, that's not really valuable growth because you're not really growing a good return. Grow 0 spread, no value. The difference with company B is they're growing a very high spread. They're borrowing at 10, making 20, and the more they do, their value goes up exponentially, right? In Boston Consulting, they used to call these stars. These are stars, right? High growth, high return companies. This is Lilly, right? High value here. And if you grow a high return, you become really, really valuable. This is NVIDIA, right? This is Apple. This is Microsoft, right? All those companies, high growth, high return, right? And those are the ones that we all aspire to because that's the ones that are really going to create a lot of value. And the big difference between the two, the treadmill and the stars, is whether or not it's good growth or bad growth. Not all growth is good. The next scenario said, okay, what happens to company B when the growth starts to slow? Everybody matures. These are what BCG might call the cash cows. So the next scenario basically said, keep the return high, keep it at 20%, but start lowering that growth rate. And so as you lower the growth rate from 8, 5 to 3, you'll notice that company B's value went down. Company B's multiple constricted, it shrank, right? This is the cornerstone of expectations in action. I price you as if. I price you as if you're going to make 20 cents growing at 8% a year. I realize I was too optimistic. You're going to make 20 cents, but you're only going to grow 3% a year. Well, 20 cents growing at 3% a year is worth less than 20% growing at 8% a year. Your value and multiple come down. This happens to all mature companies. All right, law of large number effect. As you get bigger, percentages go down for growth, therefore multiples go down. All right. And a lower multiple at this point doesn't mean it's worse. It just means it's different. A high growth, high spread company is going to have a different multiple than a low growth, high spread company. Right. And they will be different. They have to be mathematically. The final of these major scenarios, to put growth at 8, make your spread negative, 10% WACC, ROIC 8, and then grow that. What happens when you grow the negative spread in that last scenario? The growth rate goes up. What's going to happen? What happens to the value? What happens to the multiple? Gets worse. All right. Keep storing value at a faster rate, value is going to go down at a faster rate. Right. I call these the black holes. You just throw money away. Right. Not coming back. So this is very painful for value creation. This is value destruction. So accelerating value destruction just makes the situation worse. That's a very low multiple company. Right. So the point is, what do you do when you're in this situation? Slow the growth. Stop the value destruction. So if you have a negative spread, instead of growing 7%, grow 3%. What you're doing is you're not growing the bad stuff as fast, which means you're going to be more valuable because you're just destroying less value. Right? Or don't grow at all. Avoid the bad stuff, become more valuable. Or shrink, divest, lay off, shut down. All right, just avoid that bad growth. Now, I'm not talking about early investments that have a chance to be your stars, but I'm talking about if the business just has no hope of improving in the future, like what are you doing? All right, those are just the money sucks from a value standpoint. So I'm telling you, those scenarios will tell you what's going to happen with pretty much anything that gives you information. Think about a trade challenge. I'll give you an example. So earlier today, top news, there's some headlines about NVIDIA. I don't know if they're still at the top of the headlines because the screen goes fast. But if you look at the news for NVIDIA today, 2 headlines. Headline number 1, NVIDIA CEO says customer relations tense due to shortages. Headline here, NVIDIA's Blackwell chip delay is center stage amid stock slump. Basically what NVIDIA is saying is they can't produce enough of their AI chips right now. And as much as everybody wants to buy them, they're just not available. And it's a short-term supply issue. And this is a little unexpected, right? What's going to happen to the share price? What should happen to their share price? Based on this information. I see some people pointing down. It's going to go down. Because here's the point. Context the key value drivers. High return, slightly less growth. That's that third scenario. You're going to see a lower valuation. It's kind of like the maturing company. Play it out. Take this high return, slightly less growth, lower value. That's what the headline's telling you. So I'm saying if I'm doing the Bloomberg Trade Challenge, I read that headline, I know NVIDIA stock price is likely to go down. Now there's some algorithms in Wall Street that will work faster than we can in figuring this stuff out. But even in the book, it says it takes a couple of days to fully realize negative information. All right, so if you're thinking about like, how do I do some things? That's the point. Think about the company that's going to actually have better expectations than what the market expects. Well, you could trade on that or worse expectations because you'll have a feeling, understanding of where those expectations are, what should happen to the stock price when the new information comes out. That's why around earnings season, you see such big changes in stock prices because new information is coming out and the markets are reacting. The final scenario I want you to understand which is more advanced. That was in the exercise. I'll summarize here. We go back to our original numbers. Company A had zero spread. What if company had a zero spread with an 8% ROIC and an 8% WACC? Company B had a 10-point spread, but what if it had a 10-point spread with a 22% ROIC and a 12% WACC? So the spread stayed the same, but I changed the hurdle rate, right? So in the case of company A, even though they still have a zero spread, 8 and 8 versus 10 and 10, their multiple in value are higher because I'm discounting those cash flows at the WACC. And if I discount those cash flows at a lower rate, they're worth more. Company B has the same spread, just 22% ROIC against a 12% WACC. When the WACC went from 10 to 12%, even though the spread stayed the same, the value went down because I'm discounting those cash flows at a higher rate, and therefore you're worth less. So this is the part that people often overlook. That's why I call it advanced. Discount rates matter. That's why there's so much attention right now with what's going to happen with interest rates with the Fed. Because the Fed starts cutting interest rates and cost of capital start coming down, all things being equal, stock prices go up. Right? And that's, as I showed you last semester, one of the sections where they all lost money. Did you see that for your trading challenge? Part of the reason the second half of the semester why it was so bad for everybody is because during that period of time, long-term interest rates were actually going up. And there was nothing anybody could do because when cost of capitals went higher, prices went down. All right. And so that was the market that we were in. Today, we're in a different market, right? But I'm just telling you, this is the final scenario. So what I showed you here today, and I'm just using some simple language, is I showed you that you're going to see situations where I call the treadmill, growth at no spread. You're going to see situations called the stars, growth at high spread. You're going to see situations where you get cash cows, the maturing companies. Right? And you're going to see situations where you have your kind of black holes. The company's just destroying value, have no hope in the future. And then you're going to see a situation where the risk changes. Those will help you understand what should happen to value. It will help you understand as we get deeper in the math and valuation. It will help you understand what goes on when we talk about multiples. It will help you understand the real world and in your trading challenge. Okay, so this is fundamental. Questions? All right, it is this point that we're going to end today. So a couple things. One, where's the sign-in sheet? All right, so there. If you didn't sign the sign-in sheet, please sign before you leave. 2, make sure for your HCA screenshots, make the adjustments we talked about today. 3, that HCA assignment is due Monday, 10 a.m. 4, we will not be having a live class on Monday. Got a previous thing, can't be here. But I'm giving you class time on Monday to finish your Bloomberg certification, which is due next week. A lot of work to do on that. So take advantage of Monday's class time, continue on your certification and trading challenge. Next live lecture, a week from today, next Wednesday. All right. Have a good day. Have a good week.